So thank you very much for inviting me. I appreciate it. Thanks everyone for being here. I have never met the previous presenter, Mark Sachs, but I will say this. He said a number of really brilliant things. I'm in a good position to judge that because I've been trading for half a century. So this summer was 50 years since my first trade in the summer of 1967. The things that Mark said that most impressed me were this. Market profile. If you study anything in the market, understand the market profile. The original book written by Peter J. Stottlemyre, fabulous piece of work. Another thing that Mark said that I totally believe in after being many years a trader, trade to reduce risk. People ask me, what's my job? I tell them, my job is to manage risk. If you're managing risk, minimizing loss, getting out of danger as quickly as you can, or what I call the danger zone, if you have even the marginally successful method, you will make money. But I have something very refreshing for you today. I will not try and sell you anything. You don't need to buy anything from me. If you're interested in what I do, go to my website, www.jakebernstein.com. Look at the testimonials, look at what I do. If you have an interest, wonderful. If not, maybe I can teach you something today. I've only been trading for 50 years, so it's possible I might be able to teach you something. Now, I could easily have decided to teach you trading methods, trading systems, but I have found that that goal in a period of 35 or 40 minutes is really difficult to do. All that would happen is I would leave you with more questions than answers. If you have more questions than answers, you will want to come to me and buy things from me. That's the purpose of what a lot of people do. They teach you things that you can't understand, and then they say to you, of course, I will sell you the information. There's a lot of information out there. There's a lot of good information. There's mostly bad information. No reflection on anybody who's presenting at this conference. The bottom line is, you need certain things in order to be successful. I'm going to review some of those things with you today by going through my top 10 trading rules, and actually I lied, it's really 11 rules. So why listen to me? Number one, I've been doing this for 50 years. I've written 45 books. I've written the 3 best-selling books on day trading from McGraw-Hill. I'm a real trader. I've spoken at 800 or more webinars and seminars throughout the world. I've been on Wall Street Week, CNBC, I've been quoted in Barron's, and so forth. My clients include individual traders, hedge funds, banks, quantitative traders, anyone who's interested in clear, objective, rule-based trading, which is what I do. So let me give you some good news. The good news is we do have things that work. The bad news is I can teach those things to traders all over the world, and I have done that. I've published them in my books, but people just don't do them thoroughly, objectively, or clearly. People always want to find a way to shoot themselves in the foot. I realize that does not include anybody here at today's session, but that's for everybody else. Most other people just don't want to follow the rules. The sad news is this. In order to make money trading, you don't need stuff that's complicated. You need some very basic rules. I'm not going to give you the same old basic rules that you've heard about, like limit your losses, let your profits ride, and stuff like that. We're going to approach it from a different point of view today. So, why? The topic is very important today because we have many choices. As time goes on, the more time goes on, the more choices we have. The internet has given us a lot of flexibility and a lot of information. One moment, please. I need to get some quiet in my office. Hey, guys, I need some quiet. Okay? Okay. So the internet has given us a lot of information, most of it really bad. If you punch in the term day trading in a search engine, you will get about 1.5 million responses, most of them being things that people are trying to sell you. So there's too many choices, too much information, too many decisions to make, too much news, too much information, too many opportunities. The more choices you have, the more decisions you're going to have to make, and the more confusion you're going to get. So my goal is to get a lot of quality, forget about quantity. You don't have to trade a lot to make good money, but you need a definitive process that aims at quality. So everything I do is about process. I want high odds trades, and I want large profits. You need a rule-based procedure, and you need to focus. You can't trade everything that moves. You need to focus on specific stocks, specific forex pairs or specific futures. You're better off trading a few things well than many things poorly. So you want a few great trades. Why don't we want mediocre trades? Because anybody can do that. By the time you get through day trading, small trades, small moves, even with big positions, you might as well work at McDonald's. I'm not interested in doing that. I'm interested in making a lot of money. Why? Because most of your trades will break even after all said and done. 80% of your trades are going to be break-even trades after you add it all up. 10 to 20% of your trades will account for most of your money. How are we going to do it, and when are we going to? Those are key issues that we need to talk about. So we want to focus on big moves. I'm not going to spend too much time on this slide, but I want to show you that actually the 11 basic rules, and then of course take questions. So what do I consider big? If you can find a move that's worth 100% gain in futures, that's big. In stocks, a 200% move or more. Why these numbers? Based on experience. How big can you make and how much money can you make in less time? Easily. If you have a good day trading method, you have to compensate for the relatively small amount of profit by trading a larger position. What you want to do is find common elements. In other words, what are the common elements of winning trades? You can search for them with scans using computer power. Then you have to execute. And by the way, this is the biggest problem right over here. I have some extremely good trading methods, extremely reliable, high probability trading methods, but many people can't execute. There's always going to be something that gets in the way of those people's decision-making process. You want to use multiple positions. If you're a 100 share trader, trade 300 shares. If you're a small forex trader, trade a larger position. Why? Because you need to have that maximizing strategy. Maximizing strategy is where the real money is made. A lot of people come to me and they say, Jake, I day traded gold today. I'd made $500. $500? That's nothing. If you made $5,000, I'd be impressed. Most traders are able to enter trades, but very few people know how to exit a trade. Exit is more important than entry. Exit has to be just right, and it has to be at a profit maximizing strategy, which again, I teach in my work. So my mission, I want to continue to fix these critical issues. So let me just say a few things. I like to be totally clear in my work. No looks like, no could be, no probable this, probable that, no interpretation. Clarity, specific rules. I don't like to create dependency. I don't want anybody to depend on me. I've made my money. I do really well. I've done really well. What I want to do is have you maximize your trading skills and share my knowledge with you, which is based on my 50 years. So let's do this. I'm going to skip to rule number 11. And again, these are not the standard rules. Looks like. These are the two dirtiest words in the trading world. What the hell does looks like mean? People look at a chart and they say, it looks like the market wants to go higher. What does that mean? You watch CNBC and you'll see the headlines. The headlines say, Dow trying to close higher today. The Dow trying to make a new high today. What does that mean? How does the Dow try to do that? This whole thing about interpretation, take 10 people, give them a chart on the Elliott wave and say, go tell me what is happening here. Without consulting with each other, you will get 9 different answers. That doesn't work for me. If you're really good at the Elliott wave, and I don't mean to offend anybody, wonderful for you. If you can make it work for you and if you can make money with it, fantastic. I can't do that. I need clear, specific rules that are based on repetition, statistics, and probability. So if you have to say the chart looks a particular way, or you have to interpret a chart, or you think this is where support might be, or if you don't have an objective way of determining exact support or resistance, or defining exact support or resistance, you've got nothing. Let's go to the beginning. Top 10 rules. Don't trade anything that scares you. Why is that? Look, a lot of people say to me, I'm afraid to pull the trigger. Why am I afraid to pull the trigger? You're afraid to pull the trigger because you don't know what the hell you're doing. And number 2, you're afraid you're going to lose money. If you're afraid you're going to lose money, then clearly you don't understand the game. If you trade something that scares you, you're going to make an emotional decision. If you make an emotional decision, most of the time that decision will be dead wrong. You cannot make emotional decisions. So a top trader told me many years ago, the best way to make money in the market is to not care. And it sounds contradictory, but it's not. If you care, you're going to start doing decisions based on emotions, and that's not good. Most traders that I've experienced, and believe me, I have spoken to and personally mentored hundreds of traders all over the world. They will say things like, oh, I've got a profit and I'm afraid the profit's going to disappear. So I'm going to take the money right now, even though my strategy says don't do it. That's how most people trade. Or they say, well, I put this trade on, I'm behind $1,000. I know my stop is $1,500, but I'm already losing $1,000 and it's getting close to the end of the day. I need to get out. Those are the kinds of decisions that you shouldn't make. Those decisions are based on fear. Fear indicates you don't understand the methodology. Fear indicates a lack of confidence. If you have a lack of confidence, you won't have discipline. If you don't have discipline, you lose money. If you lose money, you'll lose more confidence. You lose more confidence, you lose more discipline. And that's how the whole thing goes. So how do you know if you're scared? You know if you're scared if you care. Now think about that very carefully. Rule number 2. Always use a trading model. A trading model. What the hell is that? You know what, I'm having trouble seeing the questions here. I don't see the whole thing. One moment, please. You know what, if we could do this, I will save a few minutes at the end of the session for questions. And maybe one of the organizers can relay the question to me because I can't read them. Okay, always use a trading model. What's a trading model? A trading model has to contain 3 elements: setup, trigger, follow through, STF. Example, let me show you. Here's an example. At one of my websites, seasonaltrader.com, I can go to the computer and ask the question, are there any seasonal trades in September, October, November that have high probability of success? If I do that, I come up with a rule. The rule is this. If I took all the gold contracts from the start of trading in gold futures in 1975 and made one chart mathematically that shows what gold typically does, this is that chart. It shows that this period of time from mid-August to early October, late September, has been a period of time during which prices have gone up. I can go back to the computer and ask the question, give me specific dates. Computer says, if you bought gold futures on the close of trading September the 1st and got out on the close of trading September the 24th, or if you got out with an average profit of $2,270 or $22.70 per gold futures contract, you would have been right 71.4% of the time. Now, for most people, being right 71.4% of the time is incredible because they're happy to be right 50% of the time. But the good news about it is that this trade tells us everything we need to know. The contract or the stock, long or short, entry date, time of day, end of day, exit date, percent stop, profit to loss ratio, average profit, average loss, max consecutive wins, max consecutive losses, and everything we need to know. It's 100% objective, and that's what I mean by setup, trigger, and follow through. However, in the scheme of things, we know that 71% accuracy is not 100% accuracy. How are we going to improve that? In that model that I told you about, setup, trigger, and follow through, this is a setup. It's a pattern. I can't act on this pattern unless I have a trigger. In my work, a trigger is what everyone else calls a timing indicator. On the end of the day, September the 1st, I will look at trigger. The trigger is an objective indicator, and it will say, is the trend in the direction of the trade? If the trend is up, and this is a buy trade, the trade goes on and increases our probability of success. Then we have follow through. The follow through consists of the $21 average profit per trade. This is what happened this year. Entry date, exit date, but first the average profit per trade was hit, so therefore the trade was closed out before the exit date. Very simple strategy, and we can do this for stocks and futures. So going back to the rule, we have to understand setup, trigger, and follow through. Very simple, very straightforward. So the setup is a pattern, the trigger is a timing indicator, and the follow through consists of two aspects: managing your risk and maximizing your profit. Most people in this trading business don't understand anything about maximizing profit. People call me up and they say, you know, Jake, I think I'm a pretty good trader. I say, what makes you a good trader? They say, I know how to take my losses. Well, that's a wonderful thing. Knowing how to take your losses is a wonderful, wonderful thing. The bad news is if you don't know how to maximize your profits, how to turn a $500 winning trade into a $6,000 winning trade, if you don't know how to do that, you will never make money. I guarantee it. So setups are found using patterns. Patterns are validated with historical data. Timing has to confirm a trigger. I use three major timing triggers, and I've been using them for many years, and they're very clear, very consistent. If there's no trigger, there's no trade. Keep it nice and simple. At my age, 71, I like to do things the easy way. Less work, less time, more return. So you need to understand and use seasonal strategies, which I just showed you. Why? Because they are the highest probability thing you can do. The only other thing that is really remotely close to seasonals is the market profile, which gives us a beautiful understanding of the buyers and sellers in the marketplace. And combined with timing, it's a fantastic methodology. So I showed you the gold seasonal trade. Let me show you something else. I'm going to focus on this time of the year. If I look at a stock, for example 3M, and I'm looking at one composite chart which shows all years of 3M combined into one pattern, what does the pattern show? At the top of the chart I've got the trend, I've got weeks up and weeks down. At the bottom of the screen I have percentage of time up or down by week. So if we focus on the green box down at the bottom right, those arrows up, which begin in October, indicate high probability up weeks. Example, second week of November, plus 74, meaning that 74% of the time since 1975, the price of this stock has been higher on the close of the week than it was the week before. So this ain't rocket science. It shows us that this period of time from October through November through December is the most bullish time of the entire year. But this is just a setup. It's not a trigger. The setup tells us there's a pattern. I want to take that pattern and turn it into a trigger. But before I do that, I need specifics. Here are the specifics again. Look at the numbers. October 1st through February the 18th of next year. All the statistics are there. All the probabilities are there. The good news is it's real. It's historical. It's factual. It's statistical. It can be tested. It can be looked at specifically. No interpretation. No matters of opinion. The question is, what do you do with it? The fact of the matter is, most traders that I've met are unable to hold on to a trade from October the 1st till February the 18th of next year, unless it's a losing trade, right? The definition of investment, an investment is a day trade that ended the day at a loss. Suddenly it becomes an investment and you're married to it. So because we know that most traders can't hold on to trades that long, we want to use another procedure. Get out of danger. Get out of the trade, part of the trade, when you reached your first target. That first target, percent average profit, 12.69. 12.69% of what? 12.69% of the entry price on the day of entry, which is defined as October the 1st. So what do we do if the market is closed on October the 1st? We have a rule for that. We've got a rule for everything. If the market is closed on October the 1st, we get in on the close of trading the next business day. It's all part of the process that is 100% specific and completely repeatable by anyone who has the wherewithal to follow the rules. One of the things that never ceases to amaze me is this. I've personally trained many doctors, trained lawyers, I've trained engineers how to trade as part of my mentoring program. The funny part about it is that someone who is successful in their regular business life comes into the market thinking that somehow the market's a gold mine and they don't have to apply the same discipline that made them successful in their career. How stupid is that? Trading is a business based on rules, and if you know the rules, you'll make money. If you don't know the rules, you'll lose money. It's really simple. Let's go on to the next one. This is the period of time that's indicated by that trade in yellow. How about another one? S&P, 1970 to 2017. Here's that period of time, and we are in that period of time right now. Don't get me wrong. I'm not saying to you that this will work this year. I'm saying to you it's a question of probability. Everything we do in trading is a question of probability. We take that probability, we improve the probability of that pattern, the setup, and turn it into a trigger if the market is going in the right direction based on a specific timing indicator. And then the third step is we maximize the profitability using a specific profit maximizing strategy based on multiple positions, and we get out of danger very quickly to reduce our exposure. So going back to the first point I made, my job, I manage risk. If I'm managing risk and I've even got a marginally successful proper methodology, I will make money. Let's go on to the next slide. Find and invest in big moves. How? Different tools in different time frames give different results. If you're looking to make money day trading, and the thing that's, put it in perspective. I already told you I've written The Complete Day Trader, The Complete Day Trader 2, the second edition of The Complete Day Trader, how day trading works, and all kinds of stuff like that. I've written all those books. You can have all those books and follow those methods and still not make money. Why? Because the market is not 100% predictable. You know that. The 90-10 fact of life is this. 80 to 90% of your money is going to be made on 10 to 20% of your trades. You can have a bunch of big winners, a bunch of small winners, a bunch of small losers. They wash each other. They wash each other out, neutralize each other out. If you don't know how to take the big money in the big move, you're doomed. If you know what I'm talking about, you've been there, then listen carefully. Think about this. People say to me, well, Jake, I've got my trading rule. My rule is this. As soon as I made $1,000 for the day, I'm done. I go home. I scratch my head and I say, why do you want to do that? That's totally stupid. Your goal, make as much damn money each day as you possibly can. Don't quit. You're putting a limit on how much you can make. What you want to put a limit on is how much you can lose. It's really simple. Manage the risk, manage the risk, manage the risk. So how to find the big moves? I have a number of methods for doing that. The good news is everything that I do is specific and rule-based. If it's not rule-based, it's not going to work. A lot of people are in love with the 50 and 200-day moving average. When the 50-day moving average goes above the 200-day, it's called the golden cross. When the 50 moves below the 200-day, it's called the death cross. We have computers. Go to a computer and test those moving averages. You're going to find out they are pathetically inaccurate. Then you say, well, why do the guys on CNBC talk about it? Because, my friends, that's all they know. They don't know any better. They believe it. Don't believe it unless you see it and test it. Let me give you another example. Here's a completely different chart. The cyclical behavior of lumber futures. Why? Because it's repetitive. It's not perfect. The red lines over here show the repetition of this pattern every few years. The green is the Commitment of Traders report, which is available for free from the government. The green part, the green area shows commercial buying, big trader buying. On the bottom of the screen, I've got small trader negative sell, small trader opinion. So when the small trader is very negative, as you can see down at the bottom, if we go to the second red arrow, cyclical low, commercial buying, small traders selling. Commercial buying, cyclical low, small traders selling. Commercial buying, cyclical low, small traders selling. This is just one of the patterns that we use, and what's interesting about it is this. At the bottom of these moves, the news will be negative. If you're listening to the news, you're doomed. Use the news by being proactive, not reactive. So as an example, if we go to this low right over here in 2009 in lumber, and by the way, there's an ETF for virtually every market now. Lumber futures, ETF, WOOD, CUT, housing stocks. All of these move together, so there's a lot of choices, a lot of proxies. So if we go to the low in 2009, which is right over here on the chart, the first red arrow, you can see that it was a cyclical low. It came a number of years after the previous low. Commercials were buying at the bottom, and small trader was selling at the bottom in 2009. And the news, lumber prices dropped to record lows in 2009. Demand will drop. Lumber has worst industry in 2009. The news will be contrary to reality. The news will discourage you from making trades. Let's look at this one. British pound versus the US dollar. Look at the combination. Cyclical low, and this cycle low has been approximately 8.1 years from low to low, about as perfect as you can get. And at the bottom, where the big red arrow is, we have the largest commercial buying in history, and we have the most negative sentiment that we've had since 1998. So what does that say? It's like the Matrix. There's two worlds out there, the world that everybody thinks is the world, and the world underneath the surface. Why would people be saying the British economy is going to go to hell in a handbasket and the British pound is going to go to hell as well, at the cyclical low, with the heaviest commercial buying in history and the most negative sentiment since 1998? This is how to spot big moves. But all of this is a setup. We need a trigger. And the news again, that's 2009, which was the bottom all the way back here. Let me get my mouse working here. Just one moment, please. All the way back, 2009 at the bottom. Where's my tools? Just one moment, please. Let me get my drawing tools. I will find that drawing tool. Just a moment, please. Computer's not cooperating with me. Here we go. One moment, please. Here we go. All the way back here, 2009 low. And the news, very negative. One moment, please. The news, very negative. Again. So, I'm not going to spend time on this. You can look at the presentation later. Rule number 6, trade in multiple units. Why? You want to trade in units of 3. 3 contracts, 300 shares, 600, 900, whatever you can afford. Make sure that you do it so that you can get out a part of your position at a first target to reduce risk to 0, then use a trailing stop and a second target or a third target. That's the key to making a lot of money trading, no matter what market you're trading, no matter if you're day trading or position trading. Number 7, know and use my concept of the danger zone. The danger zone. Until you reach your first target, you're in the danger zone. Danger zone meaning you're in danger of taking a loss. You want to take your first profit, effectively move your risk to 0, and take the free ride after that. Rule number 8, avoid chat rooms like the plague. Look, if you go to chat rooms, you're going to be in the room with a whole bunch of losers, a whole bunch of people who are anonymous, are going to be touting their positions, spreading all sorts of fake news. You don't want a chat room. You don't need a chat room. You don't want to be infected with that stupidity. Trade your own game, play your own game, and don't listen to what anybody else says, especially if they don't have recognition in terms of being in the business for a long time, or if their methodology is not objective. Avoid chat rooms. It's poison. Know and use my 3 losses rule. Very simple. Somebody here today will probably teach you trading methods. They'll say, this is really great stuff. It may be. I don't know. But what's important is this. Don't start trading any new methodology until A, you understand it, and B, until it's lost money 3 times in a row. Why? Because every strategy has drawdown. Every strategy has periods of time where it doesn't work successively. What you want to do is start using the strategy after it's lost money a few times, because then if it's a good strategy, it'll get right back on track. My last rule, don't tell people what you do. I never do when I have neighbors. You know, in this venue, yes, people know what I do. But my neighbors, they don't know what I do. I don't want to talk to them about it. I don't want people coming up to my house and bothering me and saying, Jake, what should I do with my 401k? Or Jake, what's a good trade? Jake, you got any good tips? That goes nowhere. If you're right, they'll come back and want more, and they won't want to pay you for it. If you're wrong, you're a villain and you're not good. Don't do that. Trade your own game and be a loner. So, we've already been through the looks like rule, and here's very simple. If you're interested in anything I do, go to my websites, tradefutures.com, jakebernstein.com, or jakestradingstrategies.com. See what I do. If you like what I do, wonderful. I can help you with a lot of good stuff. If you don't like what I do, if you've learned enough here today to do it on your own, absolutely wonderful. So I do have time for some questions. I've given the bulk of my presentation. If there's no questions, I'll finish early and let someone else take it over. So if one of the organizers could relay questions to me, because I can't really see them here in the window.
Okay, no problem. There's actually a couple of comments. Someone from John mentioned he bought and read 2 of your books that actually helped him decide to become a trader, and he just said thank you.
Oh, you're welcome.
All right, and then there's a comment from Richard that says, respect money and at the same time be indifferent to it.
Beautiful.